Let's start chapter 15. Now, chapter 15 is the money. And I know that you're not going to be bankers. And I know that you say, well, why as brokers do we need to know, the money system and all of that? Well, the truth is maybe your buyer is a little bit short on the down payment. So maybe by knowing the money, how it flows, what can they afford? Maybe you know how to direct them to what kind of banking we can do. Is there a loan product available for them, right? Maybe you can figure out how they qualify. How much can they afford based on their income? Quick, it's not permanent. You're not going to lend on what your numbers are, but it's the difference between showing 25 houses at 300,000 and then they only qualify for 210, right? For 210, you've wasted a lot of time. So to be able to get them to there and what they should expect, because at the end, when you get the settlement statement before the closing, you're responsible for going over that settlement statement and taking a look at it and making sure all the numbers are in place. And if something doesn't feel right, you may not know how much title insurance costs, but you can surely know that whether something costs $1,500 or $5,100, maybe there's a transposed number there. Maybe you can call up and say, hey, I got an issue. I think there's something wrong. Explain this to me. And then you can do that. But at least you'll have a general idea of how the money flows, where it comes from, right? And that's what we're going to talk about. We're going to talk about primary lenders. We're going to talk about secondary lenders, secondary mortgage markets, okay? So we're going to talk about all of those. And then who's going to lend the money? Where do we get it? How do we get it? Okay. And that's what chapter 15 brings us. And then we're going to also talk about the information that advertisers have to give us to make sure that we understand what the true cost of borrowing is. And that's a problem. We tend to be overexcited about seeing 0% down. There's a whole bunch of other information you need if it's 0% down, right? Or only $105 a month. I'd like to know how many months that is, right? Is that good? Is that bad? $100 a month, right? There's more information I need. So there are laws in place that help us get that information. And that's what we're going to talk about in chapter 15. So we're going to get into a little bit of the nitty gritty of how the money flows. What happens? How do we get interest rates? Why are interest rates increasing? Why do they go down? The flow of money, the Fed, all right? All right, so chapter 15 starts with the real estate financing and practices. This is what we're talking about, all right? This is where the money flows. All right, so the first thing we want to talk about is the Consumer Financial Protection Bureau. The CFPB is the cabinet level organization that advises the president and all of the Congress that holds the purse strings, all right, they are in charge of consumer protection. They're our advocate if I'm a consumer, all right? They're in charge of 7 federal agencies, which include 3 that are important to us. The Fed, Federal Reserve Bank, HUD, the Department of Housing and Urban Development, right? And the Federal Trade Commission. Those 3 are important to us as brokers, all right? Consumer Financial Protection Bureau also enforces regulations on banks, credit unions, mortgage-related businesses, right? They make the rules. They make the rules. They administer the laws that touch mortgage lending. They're very involved with mortgage lending to make sure that we understand what these things are. So, as we said, we have oversight of 7 federal agencies, all right? And they also administer all of the major lending laws. There is the Real Estate Settlements Procedures Act, RESPA. We'll talk about RESPA in detail, okay? RESPA requires full disclosure of all these settlement charges. You're going to charge me points. What are you going to charge me for? How come if I have 1 credit score, I get a higher rate? If I get a higher credit score, I get a lower rate? Why? What's my why? All right. And it also prohibits referral fees or kickbacks from service providers to the agents, brokers. So that's RESPA. And then we have Truth in Lending and then Regulation Z. We'll hear that called TILA, Truth in Lending Act, all right? And Regulation Z. We'll talk about APR and our actual cost of borrowing. What's that going to cost me? And I'll show you in your settlement sheet, I'll show you an example of a settlement sheet that'll actually show you you're going to get in this particular case, it was early, 3.875 interest rate for this loan. But then after you pay for loan origination fees and underwriting fees and everything else, it gets to about 4.3%. That's not 3.875, that's 0.5% more. So, but they have to show you that. And that's because of the CFPB, Consumer Financial Protection Bureau, all right? We'll talk about all of those things. And then the TILA RESPA disclosure. So one of the organizations that's controlled by the Consumer Financial Protection Bureau, CFPB, is the Fed. If you simply open a newspaper nowadays, you remember newspapers. If you simply open your browser and look at a newsletter of some type, you will have heard about the Fed. What are they doing to interest rates right now? They're going up, right? Why? To try to curb inflation, try to bring it down, try to stop borrowing. We're spending too fast, right? So there's more profit to be made and all of those other things, right? There's shortages all over. So inflation is high. So the role of the Fed is to try to make borrowing a little tougher when inflation is high and a little easier when inflation is low, okay? So they're trying to maintain the markets. They're trying to gain some equilibrium here. It's okay if the economy grows at 1% or 2%. That's not a big deal, all right? It's when it grows at 10% a year. That's a problem, right? And that's where we've been over the last year or so, is 8.5 to 9%. That's not a good thing, all right? So they're going to try to maintain these sound credit conditions, all right? They're looking to make sure they get equilibrium. They don't want too much inflation. They don't want deflation. They don't want this thing going negative either. They have to kind of play it by equal. And they're trying to create a favorable economic climate for everybody, right? Companies have to make profit to do reinvestment, but consumers can't get ripped off, right? So right now there's a fine line with companies trying to make the profits that they lost in 2020 and 2021. They're trying to make them back. So they're charging extra for everything, right? They have shareholders, they have stockholders. Stockholders took it on the chin. Stockholders want some money back. They're making profit. And you know what? We keep paying for it. So on the other side of it, it's a problem because there's pent up money, so we're willing to pay for it. Look, if I ask somebody for $1 million and they give it to me, whose fault is that? And that's really what's happening. We're just giving it to them. We're not stopping. So we got to try to slow that down, okay? We got to try to slow that down. All right, so they want to make sure that the money and rates flow back and forth. That's an open market. They also do this. They control the reserve requirements for the banks. What do I mean by that? Well, if I say to the bank, if I am the Fed, and I say to the bank, okay, you have to keep 10% of all of the loans you make in reserve in case of emergency, well, that's going to tighten up money, right? I got to make sure I got 10% in my bank vault at all times. But let's say the Fed comes in and says, all right, you know what? For the next 6 months, you only have to keep 3% of your reserves. So what does that give them? It gives them more money to what? To make loans, right? So the banks make loans. 6 months down the road, the Fed comes back and says, whoa, 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 we're too hot. You got to keep 15% in your reserve. So what happens now? They can't make as many loans. It pulls back. Interest rate's going to go up. People are going to borrow less, right? So that's how they kind of manipulate the market, okay? They manipulate the money and try to keep it, that ebb and flow, try to keep it regular. So it depends on how people are paying. They also set interest that the banks borrow at, right? They're borrowing now at about 3.5%. The banks are, which means they're adding their 3% and you're paying 6.5%, okay? So the Fed lends money to these banks, these primary lenders. These are the primary mortgage markets, all right? So that's what they do. They bang these things through and they work on them. And we'll go through a lot of this. So there are 3 factors in mortgage lending, mortgage financing. The first one is the Federal Reserve. We just talked about that. And then you have the primary market, and then you have a secondary market. What happens when Bank of America makes, or the big bank, it doesn't have to be Bank of America. What happens when they make all these loans? How do they get their money back? How do they make more loans? If they run out of money in the vault, what do they do? Well, that's when they go to the secondary mortgage market and they sell these loans to Fannie Mae and Freddie Mac and all these folks who will buy them and pool them as securities, right? Bundle and sell them. That's exactly right. All right. That's what they're doing. So they're selling them as, you can buy them as securities. You can buy them as, through mutual funds, through REITs. You can do it through Wall Street, right? That you can buy these things. And it's usually a pretty safe investment. Historically, a safe investment. The returns are not astronomically large, but they're not astronomically bad either. All right. So it's a pretty safe bet. So we're going to talk about that. All right. Those are the three. So the primary mortgage the primary mortgage market is your banks, the local banks, the big banks, the first, the Truist banks, the local North Carolina Bank and Trust, right? Any of those, right? Banks, credit unions, pension funds, mortgage bankers, all right? These are people who originate loans directly to the borrower. I walk in the door, I ask for money. That's where I go, to the primary mortgage market, right? So these brokers, these banks create their limits. All right, depending on your credit limit, I will give you X, or depending on your credit score, I'll give you X amount of money towards purchasing this. You got to put some skin in the game, whether it's an 80% loan, 75% loan, all right? Whatever there is, whatever the parameter is, we'll charge you X amount of interest. Maybe we'll charge you points, maybe we won't. So you have all these people, banks, credit unions, pension funds, mortgage bankers, insurance companies. They all lend money. They all lend money and get interest back on their money. Now, mortgage brokers, you may find that these people are around. They're not lenders. They're more of a intermediary. They match borrowers with banks who will accommodate them. All right. So they were going to bring these borrowers and lenders, these mortgage brokers are going to bring these borrowers and lenders together. How does this primary market make money? How do they do that? They charge you finance fees, right? They find your percentage, your interest payments, okay? Interest payments. And then they get loan servicing fees. They charge the banks these loan servicing fees. They got somebody, if they escrow your principal and interest, somebody's got to take care of that, right? Somebody's got to pay pay the banks the interest. Somebody's got to pay the insurance company. Somebody's got to pay the government for the state taxes, right? For your taxes. So all these things have to be serviced. All you're doing is writing a check every month. So they charge for these services, all right? And not necessarily you, it's wound into your interest rate, but they charge the bank if somebody has somebody else doing it, all right? So that's the primary mortgage. The secondary mortgage is just a little bit different, okay? The secondary mortgage market is where mortgages are bought and sold. They're going to look through it. The banks go in and they'll sell them millions of dollars worth of what they call tranches. And the Fannie will sell them on the secondary market. Now, Fannie is a quasi-public corporation. The only one that's owned by the government now is Ginnie Mae, okay? You can buy stock in Fannie Mae, you can buy stock in Freddie Mac. The only one you can that's government owned is Ginnie Mae, and she handles mostly government paper, FHA loans, VA loans, things of that nature. Sometimes Department of Agriculture loans. That's what they handle. They buy the loans, they give the banks back more money, banks make more loans, and the cycle continues. So Fannie and Freddie and Ginnie sell them on the open market, sell them as securities, money comes back, and that's how it flows. Okay. Fannie Mae buys basically all of them. That's the big player. Fannie buys conventional loans, she buys FHA loans, she buys VA loans, she buys everything that qualifies. Ginnie Mae buys just the FHA loans and the VA loans, okay? She's government, right? So that is owned by HUD, Housing and Urban Development. We have some different types of loans. Everybody's pretty familiar with conventional loans, right? If you went to the bank, you got a conventional loan, all right? These are not insured. These are not insured by a federal agency, okay? The bank or the lender is self-insured for that money, okay? The lender bears all the risk of giving you an 80% loan. If you default, they got to try to get their money back the best way possible, all right? So these are not insured, okay? They can be purchased by Fannie Mae. Now, the difference between a conforming and a non-conforming loan, a conforming loan is not a jumbo loan. Jumbo loans, I think, are over $720,000 now. But anything under that is a conforming loan that follows Fannie's rules and regulations. So she'll buy those conventional loans, but she won't buy any jumbos out there. Now, understand this, though. If I want my loan to be bought on a secondary market, before the bank will lend you the money, they're going to run everything through the Fannie Mae database and to see if they'll buy your loan. Because what happens is, if Fannie doesn't buy it, the bank is going to have to eat it. Is the bank got any kind of interest in eating your loan? They're not in the portfolio business anymore. Those days are over. And back in when the banks crashed back in 2007 and 8 and all of that nastiness that went on back there, the banks bought a lot of bad paper. I mean, Fannie and Freddie bought a lot of bad paper. They sold it to them. Fannie went through it and decided that we're not buying junk anymore. Here, banks, take your money back. But they didn't sell them. Let's say I sold Fannie $20 million worth of mortgage notes. And they found that and the run rate was about 10% was bad paper. Paper that should have never been written, mortgages that should have never been written. So instead of just taking $2 million and giving it back to the bank, and I'm just using estimates, they gave the entire tranche back. They gave back all 20 million. And they said to the banks, you portfolio this yourself. We're not buying any of it. Well, now if I have to put all of that money back in my bank and keep it, and I have to portfolio that, do I have any money to lend? Talk to Goldman Sachs. Talk to those savings and loan that went under. Talk to all of those banks that closed, those transfer houses that closed, because they didn't have any money. They ran out. They had to buy back all of this money from Fannie Mae, Freddie Mac. So this is really important that they pass muster with Fannie Mae. If you don't pass Fannie Mae, the bank's not going to write you a loan. They're just not. They're not going to be willing to accept that risk because they bear all the risk until they can sell it. All right. So they're classified based on a loan to value ratio. Usually a conventional loan is going to be 80% of the purchase price on a conventional loan. You need more than that, you're probably going to have to pay a private mortgage insurance on the difference. Now, when you pay that private mortgage insurance, it's only for that, let's say you need a 90% loan. It's only for that 10% over above the 80% that you're insuring. The bank is still going to be bearing the risk for the other 80%. You're just going to pay from 81% to 90%. That's where your insurance bond is going to be, okay? And you're going to do it for private mortgage insurance. Home equity loans, home equity lines of credit, all right? These are lines of credit that are built up in your home equity, right? If you have, in the pricing of the houses have gone up over the time, good time to get a home equity loan if you need a line of credit to go do some house repairs and things of that nature, all right? Home improvement, debt consolidation, a vacation, all of those things you can use that money for. So there is equity now. If you owe less than its value by a significant amount, you can get it. All right. So these again are conventional loans. Now, the next step are government-backed loans. What if your buyer doesn't have a 20% down payment? What if your buyer has a little bit higher credit score? What if your buyer is a vet? What's he get to use? Another one is, what if your buyer is a vet who sold the house that he got his first VA loan? Does he know that he gets his entitlement back? These are questions you're going to have to answer for them. So we have these government-backed loans, right? FHA, VA, USDA, all right? And they are required to conform to HUD, Housing and Urban Development, standards. HUD has the standards for these loans. Now, let's talk about them a little bit. The first one we're going to talk about is FHA Insured Loans. Understand that FHA does not lend money. Write that down somewhere. FHA does not lend money. However, what the FHA will do is they will insure these loans to the commercial banks that says that this borrower is good and we have insurance that says they're going to pay you back. The money is lent by the conventional banks. So if I want an FHA loan, let's say that I'm really short on down payment, and my broker comes to me and says, "Did you try an FHA loan?" I said, "What's that?" They said, "Well, you're in that, if you pick a house that qualifies under FHA standards, and they have to do some qualification, and you qualify for credit and what have you, you can get a loan for 96.5% of your purchase price." What? Yeah, you only have to put 3.5% down. Wow, that's pretty good. Are you going to give me the money? No, we're going to send you back to your bank. We're going to tell them that you're going to insure an FHA loan, and we will insure it for you. And they'll give you a loan of 96.5% on that house. FHA Insured Loans, no prepayment penalties. Remember what we talked about before? FHA VA and no prepayment under $150,000 on primary. No prepayment penalties on FHA loans. And FHA loans are assumable, right? You have to be qualified, which means that you have to live in the house. Now, the points and the interest rates are not set by FHA. All they're going to do is they're going to ensure that the buyer is going to pay the bank back. These points and interest rates are set by the lenders. What's the conventional rate? Maybe it's 2 points and a 6.5% interest rate at this particular point. Maybe that's what they're lending at. You might get 96.5% at that. All right. But the FHA doesn't set the points or the lending rates. All they do is ensure that they're going to pay it back. All right. And as we're going to see in chapter 20, or we saw in chapter 20, lead-based paint disclosure is required on houses built prior to 1978, but that's every house that's built prior to 1978. Okay, you have to disclose these. 4 different types of programs. We're worried about mostly the FHA 203B. That is the most used program. This is for owner-occupied loans. Owner-occupied loans, okay? Standard conventional FHA loans. They have a 234, which is condos, 245, which could be a graduated payment loan where you're paying more off year after year. And they have a 251, an adjustable rate loan. Usually you deal with the 203B. That's our owner-occupied loans, okay? Private residences. FHA is a good program if you get your client in. Have them fill out the form. What's the worst it could say? Filled out the form. Nice job. But 96.5% money is 96.5% money, right? With insurance premium. Okay, so that's number 1. Now we have a veteran who walks into your office and says, I'm looking to buy a house. And you ask them, are you qualified? And they say, well, I'm going to use my VA. Okay, well, we need some information from the VA. We're going to need their certificate of eligibility. We're going to need their DD-214. We're going to need a whole bunch of stuff from the VA. I got to say that every time I've had to do a VA loan, they were very quick and responsive to get the information back for the veteran. Never had to wait much for that. The Veterans Administration, the VA, doesn't insure loans, and the VA does not give money either. What they do is they guarantee to the conventional lender, they guarantee that the veteran who is taking out this loan will pay that money back. And if they don't, there's a guarantee they'll get paid back. It says the VA most often does not make loans The loans that they do make are to indigenous persons for land out in the West. All right, so they do make some loans for those folks, but you're not in common day-to-day cycles that you and I are going to see. I doubt you're going to see that. So we can assume that they don't make loans. They're going to guarantee home loans made by the banks. Same thing, they don't set interest rates, they don't set points. FHA will ensure that the buyer is going to pay it back. The VA says we guarantee that the veteran is going to pay it back. Now, here's the fun part. The veteran can get 100% financing on a VA loan. So if they have a certificate of eligibility that we get from the Department of Veterans Affairs, there's no maximum guarantee. If they're eligible, they put in their time, they've done all of that stuff, they can get 100% financing. As a matter of fact, they can finance their VA funding fee, which is probably another $3,000 or so. They can roll that in. So they can have a loan of 102 to 103% on the price of their house. They have the cost of the house plus the funding fees. They can roll that all in, the loan. Mm-hmm. Super high loan to value ratio, it could be as much as 102%. Right? So it's high. And again, the conventional bank sets the points and the rate, but the VA guarantees that it's going to get paid back. This loan can be assumed by anyone as long as they qualify, right? Now, once we sell that, and that loan that we got from the VA, let's say it wasn't assumed, but let's say that it was paid back. At the closing, we paid our VA loan back. If I'm the veteran, I get my entitlement back. You would be surprised, a couple of things. Older vets, how much they forget that they had this to begin with. And the second thing is how much they didn't know that if they paid it off, they get it back. That's going to be up to you to give them that information. How much would a 100% VA loan mean to a veteran who's struggling to make a down payment? I'm saying that's pretty righteous, right? That's big news. So you got to give them that information. You got to let them know that, okay? Got to let them know that. All right. So they get it back. No prepayment penalty on VA loans. None. Can't have them. All right. So they have to have a certificate of eligibility that we'll get from the Department of Veterans Affairs, all right, to determine what portion of the loan the VA will guarantee. It takes a percentage and it multiplies it. It's more than we need to know, all right? But most times it's for all of it. Most times it's for all of it, okay? Again, the lenders set the rates, not the VA, not the VA. What they do, and this is for the FHA also, if the vet goes and purchases a house, let's say for argument's sake, he said he's in contract for $200,000 house. The Veterans Administration is going to send over a VA appraiser, right? They're going to send over a VA appraiser. Yeah, Lily, that's pretty much bankruptcy or foreclosure. They'd lose it. But if they sold the house and paid it back off, they'd get it back again. They're going to send, the VA is going to send a VA approved appraiser over there. And that appraiser is going to give a certificate of reasonable value. We're going to call it a CRV, certificate of reasonable value. And what that's going to say is that this house is worth X amount of dollars. So let's say I got into a contract, I'm the vet, and I'm going to pay $200,000. My certificate of reasonable value comes back, and it's only $195,000. The VA appraiser says it's $195,000. Say, I'm sorry. And I look at him and I say, all right, now here's the rule. I can pay the difference in cash, that $5,000. I can ask the seller to come down off of his $200,000. I can pay that $5,000 in cash. I can't borrow it, can't be seller financing. Or I can walk away from the deal with no penalty. And that's the same thing for the FHA. If our certificate of reasonable value or our FHA appraisal does not come back at what we paid for the house, what's we're under contract for, we can pay it in cash. We cannot borrow it. We can pay the difference in cash. We can get the seller to renegotiate and come back down, or the FHA client or the VA client, the veteran, can walk away without any penalty under that FHA or VA appraisal. Get their money back and go. Find something else. That's the rules for that. Okay, now, if you live out in the middle of nowhere, lots of farmland, lots of emptiness, you can go to the USDA, United States Department of Agriculture. If it is a rural community and you are a low to moderate income family, you can actually get a direct loan from the United States Department of Agriculture. But it's a very low income threshold, and it has to be in a rural community. So what they're looking for is to give people homes in areas where, let's face it, unless you own the farm, okay, unless you own the farm, it's hard to make a living on a farm. You got to work hard. And sometimes, you can't buy housing that's, incredibly big. But if you can get a USDA loan to help you buy that house, sometimes it's a grant. Sometimes it's a grant, right? Or a direct loan. So they have to be available, but the money runs out quick. They're budgeted. Money runs out quick. So you have to get them while it can, and it depends on where you are. USDA, if you can, if you swing it and you can fit into their criteria, it's a grant. In some cases, it's a grant. Some cases, it's direct loan, low cost, right? Something you got to look into, right? Maybe a client needs that. Maybe it'll fit. If they fit, then they should do it. Sometimes it's a 40-year repayment, right? Yeah, you had to prove a lot, right? In some cases, it's a longer-term repayment. They have 40-year loans, depending on your situation, depending on your circumstances. Yeah, and they are limited. They're budget. That's a budget item. So depending on how much money they have in the budget, that can go away pretty quick. So you got to be able to hit that right at the right time. But again, available. Check it out. Send somebody to the website. Let them look. Make some phone calls.